Welcome to Breaking News to Trading Moves. Today we're looking at a really unusual market incident, one that's a perfect case study in how modern trading mechanics work under stress. We're going to analyze this rapid, pretty much unexplained spike in Infosys American Depository Receipts, or ADRs. And the goal here is to map out the consequences. Who won, who lost, and why when a price moves for reasons that seem to have nothing to do with the company itself. The headline was just jarring. I mean, in just a few minutes, the price for Infosys ADRs just exploded upwards.
Yeah.
And crucially, right after, the company came out with a statement.
A very clear one.
Right, saying there was absolutely no corporate news, no strategic change, nothing at all happening inside the business that could explain that kind of price action.
It was a remarkable few minutes if you're watching the ticker. We saw Infosys ADRs, which trade on the New York Stock Exchange, jump almost 40%.
40%.
And this all happened, well, almost instantaneously.
A move that fast can't happen without the market's own architecture, its own plumbing getting involved. What were the immediate, automatic consequences?
Well, the market has these built-in safety nets, and a price move like that, with that velocity, it immediately triggered them.
You're talking about trading halts.
Exactly.
Yeah.
The limit up, limit down mechanism, it mandates these volatility pauses. The system basically saw the move as completely out of line and slammed the brakes on.
So the halts are like the market's timeout button to stop a runaway train.
That's a good way to put it. And when Infosys clarified that there was no news, no new contracts, nothing, it forced everyone to look away from the business and toward the system itself.
So if we completely rule out company news, we're left with the mechanics of the trading floor. What were the main theories for why this happened?
The analysis focused on three factors that probably all converged at the same time. The first, and maybe the thing that made it all possible, was just low liquidity.
Thin trading.
Very thin. The event was described as happening under holiday-like conditions. Now, that doesn't mean it was an actual holiday. It just means it was a time when a lot of the big U.S.-based market makers had, pulled back a bit. The order books were thin.
And when there are fewer buyers than sellers, any order can have a much bigger impact.
An exaggerated effect. A moderate buy order can suddenly look huge because there's just no one there to absorb the volume.
So that created this very taut environment, which I guess brings us to the second factor, who was actually doing the trading.
And that points directly to automated trading. Algorithmic strategies. They were widely suspected of being the accelerant here.
But don't those systems have their own circuit breakers? Why didn't the algos just shut themselves down?
That's the real question. The initial move, maybe it was just a slightly larger than normal order in that thin market, could have been read by dozens of different automated systems as a real trend.
So they all jump on board.
They generate these cascading follow-up orders. And in this case, that feedback loop probably escalated the spike so quickly, the speed itself just overwhelmed their internal checks before the main exchange halt could kick in.
And the third factor.
The third one goes right to the digital foundation, mechanical issues. There were pretty strong theories about, say, a ticker or a data mapping glitch.
What does that mean exactly?
Well, ADRs are complicated. They represent shares held overseas. So if the data gets misread or mispriced for just a split second, all those automated systems might see a price difference that isn't really there and just pile in to trade it.
So whether it was low liquidity, panicked algorithms, or a data glitch, the result was massive volatility.
And trading halts.
And volatility, as we know, gets monetized pretty quickly. Let's start with who benefited from this, starting with the trading venues themselves.
Right. Our winner group one.
Yeah.
The exchanges. And anyone who benefits from high volatility. For them, even this kind of chaos can be good for business.
How does that work? How does chaos turn into revenue for an exchange?
It's two things, really. First is just pure volume. All those automated orders flooding in on the way up and then on the way back down, that means more transaction fees.
Okay, that makes sense.
And second, and this might be more important, is the demand for market data. When something like this happens, everyone from hedge funds to regulators wants a perfect, low-latency data stream to see what happened.
And the exchanges sell that data.
They sell that premium data. So the venues end up profiting from the very chaos they're built to regulate.
So which specific companies are we talking about here?
You look at the owners of the big venues, Intercontinental Exchange, ticker ICE, since they own the NYSE where this happened, but also NASDAQ, ticker NDAQ, and Cboe Global Markets, ticker CBOE. Cboe is key because they manage a lot of volatility products and other trading systems that catch all the spillover when the main market halts.
Okay, let's move to the second group of winners. The people who actually facilitate the trades, the market makers. Their risk goes up, but I'm guessing their potential reward does too.
That's winner group 2, for sure. The rationale is all about the opportunity that pops up when trading gets disorderly. During that spike, and especially right after the halts, spreads just widen out dramatically.
And the spread is the difference between the bid and the ask price.
Exactly. And a wider spread means higher compensation for them for taking on the risk of holding the security when nobody else wants to. They step in to provide that stability.
So they get paid for being the calm in the storm.
Yes. And when the price snaps back after the halt, which it often does in these mechanical errors, they can realize profits on those very quick corrections.
So who are the key players in that space?
You'd look at firms like Virtue Financial, ticker VIRT. They're a huge electronic market-making firm that really thrives on volatility. And you could also consider platforms like Charles Schwab, ticker SCHW. More market volatility generally translates into higher transaction revenue for them as long as their own systems hold up.
Okay, let's pivot to a third group of winners, one that's less about the trading and more about the business consequences of this chaos, the competitors.
Yes, this is the strategic benefit. We call it the relative benefit trade. It's really about how big companies make decisions.
But why would an enterprise client care about a stock market glitch?
Because those clients, the ones making these huge multi-million-dollar IP decisions, they are incredibly risk-averse. They want stability and predictability more than anything.
And a public glitch like this, even a mechanical one, creates doubt.
It creates headline risk. It gives competitors a tool to just sow a little bit of doubt about reliability or control. The client starts thinking, if their trading has this chaos, what about their operations?
And that little bit of doubt can push business elsewhere.
This quiet rotation of sentiment, or even just a little bit of spending, tends to favor the really large incumbents, the ones known for being, stable and having these very sticky relationships.
We're talking about firms like
Accenture, ticker ACN, with its massive global consulting platform, and IBM, ticker IBM, which is just a bedrock of enterprise tech. Any uncertainty around a major rival just makes these established players look even more reliable.
All right, so we've covered the beneficiaries. Let's move to the downside. Who felt the immediate pain when that ticker went haywire?
We can go right to loser group 1, the direct peers, other IT services and digital engineering companies.
Why would one stock's glitch drag down the whole group?
It's a function of portfolio de-risking. When a headline screams mechanical failure or thin liquidity for one company in a sector, what's the easiest thing for a fund manager to do?
Sell the whole basket.
Sell the whole basket until you figure out what's going on. It's a flight to safety because nobody wants to be holding the next name that might have a similar unexplained problem. So stocks that feel that sympathy selling pressure would be names like Cognizant, ticker CTSH, and EPAM Systems, ticker EPM. They're direct competitors. And any bad news, even if it's mechanical, can create this sector-wide pressure.
Okay, moving to loser group 2. Let's talk about the practical headaches for the platforms that had to deal with the chaos from thousands of individual traders.
This one hits the retail brokerages and clearing platforms really hard. Those volatility halts, they just create a massive spike in operational work. You get a ton of trade disputes, customer complaints about what they feel were bad fills.
Right, trades that got executed way up at that 40% spike level.
Exactly. And then there's the reputational cost. Retail traders are using apps that promise this seamless, easy execution.
And when the market locks up or they feel like they got a terrible price, they blame the app.
The frustration lands right on that customer-facing platform. So that operational friction, that reputational heat, it falls on firms like Robinhood, ticker Hood, or Interactive Brokers, ticker IBKR. All that goodwill they build up with a smooth interface can get damaged pretty quickly.
And finally, let's talk about the infrastructure for this security itself. An ADR is a special instrument. What's the risk to that underlying plumbing?
This is our loser group 3. The ADR plumbing and the depository bank ecosystem. If the final story is that this was a mechanical error, a data mapping problem, the entire chain that supports that ADR comes under a microscope.
Scrutiny from whom?
From regulators, from clients, from their own internal risk teams. It means costly internal reviews, maybe regulatory inquiries, and definitely higher compliance costs for the banks that are responsible for that ADR program.
And the main institutions exposed there would be the big depository banks.
That's right. You're talking about institutions like Bank of New York Mellon, ticker BK, and Citigroup, ticker C. They manage thousands of these programs for foreign companies. A failure in one highly visible ADR, forces the entire system to, justify its own reliability.
So what we've seen is how a volatility event, even one with zero real corporate news behind it, creates these immediate asymmetrical reactions. It creates opportunity for exchanges and market makers, but it also creates real costs and damage for competitors and infrastructure.
And the key lesson here is that you have to look beyond the press release. Not every market move is about earnings or a merger. Sometimes it's just the machine malfunctioning, but the outcome for all these other companies is absolutely real. Which brings us to a final thought for you to consider. With all this new scrutiny on the ADR plumbing, what kind of regulatory changes might we see for data mapping on these cross-listed securities? And will that raise the cost so much that smaller banks can't even participate in this market anymore?
And we must state clearly that this discussion is purely the opinion of the author. This is not financial advice, investment counsel, or a recommendation to buy or sell any security discussed today.